My name is Amelia Hill and I work at UBS in ACG, which is a sub-product group of ECM, which is a JV between IBD and equities. Are you confused yet? To be honest, I think a lot of my colleagues would be, so I'm really not surprised if you are as well. However, this is investment banking, a world filled with a myriad of acronyms, jargon, and quite frankly words which really don't have a meaning until you're involved in banking when, trust me, you start using them every single day. It is often difficult to sit there in lectures and reconcile the theory that you're learning to how you think that knowledge might actually be applied in a banking environment. This video attempts to address that confusion by giving you direct access to a number of UBS employees across a variety of areas of the bank, including investment banking, equity sales and trading, fixed income trading, equities research, risk, legal and compliance, and of course, operations.
If you think about an investment bank, I guess essentially we act as a conduit between two sets of clients. So we've got companies typically on one side and investors on the other. So when a company wants to raise money, investment bank sits in the middle, has a relationship with the company wanting to raise money and advises them on how to do their prospectus and all those sorts of things. And then ultimately introduces them to the investors, the stock market investors who have the money. And that's our job. My specific job in that process is to have the relationship with the company. So, for example, Telstra, I had the interaction with the government. My colleagues in the equity side of the business, had the interaction with the investment community to sell the shares.
I started at UBS as a graduate in our investment banking division. I believed that investment banking was the best fit for my skills as it requires a combination of technical, analytical, presentation and importantly people skills. I was attracted by the idea of working with a diverse group of clients, providing advice at the board and senior management levels, and being involved in deals that had the potential to change industry dynamics and hit the front page of newspapers. Believe me, it has not disappointed. Investment banking at UBS is structured as a number of different sector groups. For example, financial institutions, property and power and utilities. And these groups provide client coverage on a sector basis. The other set of groups are product groups, such as mergers and acquisitions, capital management or hybrid capital, and these focus on providing specialised corporate finance advice. In this section of the video, we have interviewed a range of people across these sector and product groups to give you a hands-on feel for the type of work that comprises investment banking.
Investment banking is many, many things. If you're talking about the investment banking that I work in, it's advising clients. It's trying to provide them with strategic advice in terms of their business, where they go, acquiring different companies, buying companies, selling companies or parts of companies. It's helping them fund their business in the best way possible. So depending on where your company's at in a particular growth phase, it may be better to fund it with debt, with equity and so on.
So I like to think that the role of investment banking is really to do whatever is necessary for our clients to help them do transactions, to advise them on how they structure themselves, how they structure their capital, what's the next move they should be making in the industry, and we provide essentially whatever help we can in how should we advise them on that transaction, and also how can we assist them in raising funds, selling businesses, buying businesses that are really involved in delivering their corporate strategy. Because at the end of the day, it's the client's corporate strategy that really becomes our strategy in any transaction.
What we would do is advise the client in terms of the best way they could either affect a merger, if they were on the buy side, so to speak, or if on the sell side or on the defence, how they would defend themselves from an attack. What that would actually entail is day-to-day meetings with the senior management of the clients, preparing board meetings, board presentations, discussing with them, generally just providing strategic advice and valuation advice.
We spend a great deal of our time looking for new ideas and looking for new transactions. That can be interacting with other industry teams on the floor to see where opportunities are coming up. or often it can just be kind of using our contacts, or really kind of coming up with some kind of off the wall ideas to try and think what are some potential acquisition opportunities for our clients, and then we will take those ideas once we workshop them up to a client and say this is something that you should be looking at.
What that really entails is coming up with an idea to value add for the client, going to see the client and explaining why it's a great idea. And that's called a pitch, and typically you're up against many other firms, and what happens is that if you're lucky enough to win it, which we typically are here because of our position, you then go to execute. And what execution basically means is executing the idea that you brought to the client. So we're involved from everything from appointing other advisors to assist us in executing, all the way through to the actual process and the actual transaction, all the way through to the end where we see the transaction through to completion. So we're there at every step of the way from start to finish. For example, where we did Telstra last year and a couple of others. What that would generally entail, the large steps, is first of all you need to determine what you're trying to float, the assets of the business, and you'd actually put in place a structure that you're trying to float. So that would mean that you need to put in the assets, the management, the directors, for example. And then what we then do is also determine the valuation of the business, how much will it sell for in the market. And then the next process is we actually market the IPO, and we'll go to institutions and investors and explain to them why this is a good product or a good company, and then we place the stock onto the market as well. So that's basically from the start to the finish of a successful IPO.
An example of a transaction I've recently worked on is a takeover. The client actually identified the takeover target themselves, came to us, a merger implementation agreement was put in place. It was a friendly takeover. The steps that we went through were to take those two companies and produce a very high-level merger model to look at the impact of, because it's a listed entity. So we produced the high-level merger model. It looked good. So we went through the next step of producing a bidder statement so that we could take over the client on market. We produced financial forecasts that went into the bidder statement. We involved the lawyers, investigating accountants. The bidder statement went out to market. It was unanimously accepted, and the target was taken over. A compulsory acquisition is actually occurring right now.
We sit very much on the private or confidential side of the information barrier. That means that the work that we're doing is not in the public domain. It means that all of the work that we do, we must keep confidential. We can't talk about it with anybody else outside the firm. And also within the firm, there are an enormous amount of information barriers set up to ensure that no non-public information moves to other areas of the bank. At times, we'll even set up information barriers within the M&A group if we're working on a sensitive transaction to make sure that only the specific deal team is aware of the details of the transaction. Within investment banking, whilst you're on the confidential side of the information barrier, it's still incredibly important to have a good understanding of what's actually going on in the market, number one, and the economy, number two. Firstly, with the market, it is one of those things that moves so quickly, and whilst in investment banking we're not trading on that on a day-to-day basis, what we are thinking about is, are there opportunities that those movements are creating for our clients? And if values move in a certain way, what does that mean for our clients which, number one, own businesses? And also, what does that mean for our clients that could be looking at potential acquisitions in that industry? So movements in the market really can provide us with opportunities. It can also take opportunities away from us very, very quickly. So it's important to understand what the trends are, because your clients also expect, whilst you may not be a specialist in a particular area, that you have a good understanding of everything going on in the market and the implications of that for anything that they own or things that they might be looking at.
Almost every banker has a favourite type of transaction to work on. I personally like equity. There's something very rewarding about raising capital for a company that's going through a growth phase, or bringing a private company to the public market. Our equity capital markets team bridges the gap between the investment banking division and the equities division. We work with the relationship bankers in the sector groups in the investment banking team to structure the deal and to bring it to market for sale by our equities division. The equity origination side of the business works more closely with the investment banking division, whereas the syndication side works more closely with the equities division. In this section, my colleagues will discuss at a high level what we do in ECM.
Types of things that I work on are initial public offerings whereby an unlisted company looks to list on the Australian Stock Exchange. I work on rights issues, which are existing companies wanting to raise new equity via, a pro rata issue to their existing shareholders. We work on share placements whereby a company is just issuing new money. And then the other one that comes around is when there's an existing shareholder looking to sell down some stake. We'll look to do what's called a block trade to sell that down.
You can price an equity raising in a couple of different ways. You can either go out with a fixed price or a book build offering. Basically, a fixed price is just where you say, okay, the price per unit is $1, and then everyone has to pay that price. Or you can go out with what they call a book build range, and then you might have, say, 90 cents to $1 being the book build range, and people will then bid for shares within that range. You know, institution A might say, I want 10 million shares at $1, and institution B might say, well, I want 100 million shares at 90 cents. And then it's our job in ECM to work out exactly where the clearing price is. It's almost like an auction, not quite a house auction, but because there's a lot more people involved, etc. And you're actually finding one clearing price that will actually sell the entire deal. And then it's quite difficult, I think, within ECM, and that's what takes a lot of judgment, is making sure that not only are you getting the maximum price for the issue or for the corporate client, but you also need to make sure that's going to trade well in the aftermarket.
I suppose the typical steps that we see from an equity side, I suppose it's probably 4 phases. There's the pitch phase, there's probably then the the preparation phase, then there's the selling or marketing phase, and then there's the completion phase. Pitch phase, it's very unusual for you to be lucky enough to have a deal land in your lap. Usually things are pretty competitive. The banking environment is very competitive, so we usually have to work hard to pitch and show our credentials and position, show how we think that we're going to position the business. So that's a key role for the equity origination team, is to A, think of the ideas, and B, put the documentation together for that. Second phase is the preparation for deal time, which is sort of the undergoing due diligence, doing all the documentation and all the logistical work that has to go in behind the scenes before you go out and sell a deal. The third stage is what I'd call marketing and selling. That's where you go out and do roadshows, see institutional investors, you see retail brokers, and you really start, trying to sell the story. During that phase, you're obviously thinking of the selling themes that you want to get across to the investors, etc. And at the back end of that phase, we have is what we, call a book build, which is where we sit there and gather all the interest together, and work out where we end up in terms of how much demand for the transaction we have. And then the last stage is just completion, which is the settlement and effectively ticking all the boxes so that we can make sure the shares start trading.
Sitting in ECM probably had the best of both worlds in terms of interaction with both the corporate clients and also with the investors. So we would be dealing with, the CEOs, the CFOs, the investor relations guys at the major corporate clients that we deal with. But then when it comes to actually selling a transaction, we're also on the road actually talking to the investors, all the institutional clients, and even the retail brokers, selling them the deal, telling them why they should invest, and actually then collating that demand. So we definitely sit sort of not on the fence in that sense, but we actually get to deal with both sides of the fence, which is great. So the market's really important in our job. Being aware of the trends that are existing are critical in being able to, assess investor risk and demand, appetite, what sectors are in and out of favour, etc. So absolutely, being on top of monetary policy, being across of fiscal policy, international policy, economics, whatever it might be, we need to be on top of all of those things because it impacts how people invest, and ultimately it's my job to sell investments.
When I was still at school, I was fortunate enough to do 1 week's work experience on the Sydney Futures Exchange trading floor when it still operated as an open outcry trading system. Open outcry systems operate through traders yelling buy and sell orders for securities at one another across big trading pits in a really big room. Open outcry trading no longer exists in Australia, but it still exists in the United States. Instead, in Australia, banks will operate from trading floors similar to the one behind me now. Being part of our ACM team has meant that I've become much more exposed to the equities business, and the nature and extent of the number of areas, products and roles that exist continues to amaze me. In this section, my equities colleagues will give you a high-level description of some of these areas and how they interact with each other and also with the rest of the bank.
Okay, so equities as a business is made up of a number of different divisions. There's the research division, there are research sales people, there's sales traders, there's prop trading, and then there are the operators or the execution team. The way it all really works together, the research, a completely independent area. They're out there valuing companies and evaluating situations and saying what they think is, well, what their take on that company or that event is and how much they think the stock is worth, and then compared to where it's actually trading in the market, if it's a buy, a sell or a hold.
We analyse companies within our specific sector, and what that involves is speaking to management, understanding what the strategy and the business model of the particular stock that we're looking at covers. And then we go away, we do our own analysis, independent analysis, and from there we write independent research. So that reflects our views based on any sort of investigations or analysis that we've done on that company.
Research goes out and covers a company and writes research on the company. For example, they could initiate a buy on BHP with a price target of $30. And then research sales, a separate team, goes out and sells that idea to fund managers. And then if the client agrees with that view and wants to buy BHP, then the order comes down through the dealer to me and I place that order into the market.
Then when they've got the order, they then give that to the execution team or the operators, and the operators are the person who actually directly puts the order into the market.
Operations is often described as the engine room of the bank. It involves facilitating and processing trades. So once the trade has been executed, the trader will book the trade into the front office risk system, which will then feed into the settlement systems, and the operations staff will pick up the trade from there. They will confirm the terms of the trade with the client, proceed with settlement, and finally will be responsible for reconciling the positions.
The open outcry system is a long way gone. You would have seen it on TV and things of the like, people yelling and screaming. I don't think that environment's changed a great deal at times. It's probably a little bit more controlled, but it's a lot of adrenaline flowing in that room, and it's quite an interesting market because people are dealing with a fair bit of passion.
The market and the broader economy is incredibly relevant every day. What could happen with the interest rates, if they're increased or if they're decreased, anything that's unexpected is going to have a massive impact on the market, and that will drive share prices across the market or even in a particularly sector-specific area.
Some people say that valuation is more of an art than a science. Take this painting for example. If you had a number of different valuers having a look at that painting, they probably all apply slightly different techniques and get to slightly different valuations. What we try to do in banking is find the most appropriate valuation technique that applies to whatever particular sector or deal type that we're looking at. What we've done in this section of the video is showcase a range of valuation techniques and how these are applied in different areas of the bank.
To value companies within our sector, a company normally comprises construction development, and you would use, in funds management, you would use a sum of the parts valuation, PE and EBITDA multiples. To value trusts are normally valued, priced on their yield, and the pricing is impacted by gearing, DPU growth, and the quality of the assets.
I think when we are valuing companies for our clients, so for the private equity clients, they will look at it sort of on a capitalisation of earnings basis. So they will look at it on a multiple of what the cash flow is. So they may look at a retail business and say it earns $50 million of sort of EBITDA, which we talk about earnings before interest, tax, depreciation, and amortisation. And we may say we'll pay 10 times that cash number. The reason why cash is important for private equity clients is because the way that they can finance a business is all based on cash flows. Typically these businesses don't have a lot of asset backing, so you are really financing what you think the future cash flows of that business are and how much free cash there's going to be to pay down your debt. So when debt providers look at how much debt they will provide a company, they look at it on a capitalisation of earnings basis. So they will typically say, we will give you, these days it's anywhere sort of 7.5 times your free cash flow we'll give you in debt. And then what the private equity will say is, well, we will put another 3 times that free cash flow in as equity, and we'll pay 11 times the free cash flow for the business. And I think you do that because debt providers provide you with the debt, so private equity follow that tact when valuing companies.
In the UBS real estate research team, our valuation methodologies are based on a dividend discount model. It's a 3-stage model, and basically we have explicit forecasts for 5 years, and then for the second 5 years we use a assumed growth rate, and then we assume a terminal growth rate for the final stage into perpetuity. So it's basically a 3-stage DCF, but based on dividends.
Where equity capital markets is different from how the sector bankers look at valuations, whereas there's obviously there's a heap of complex ways you can look at valuing a business, and then you can always come up with various different numbers depending on what assumptions you look at. What we try to do within the equity capital markets group is overlay what the expectations of the investing community are, and that's really effectively we look at where the stock is trading, where it has traded, where we think it should trade, and where investors' expectations are in terms of valuation, rather than what the model spits out and tells us what it should be.
To get data inputs to value a property, an actual property, we would use, that would be DCF methodology, and properties are actually quite easy in the sense that a lot of the income is contracted, and then in between that we would make up assumptions as to let-up assumptions and whether we could actually increase the rent in those periods when we re-let it, leasing incentives, they'd all be assumptions.
I think by now you'll probably have a sense that investment banking covers a range of areas that require very different skills. As a working environment, this can be very inspiring and very challenging. Regularly you will find yourself working on a deal which encompasses different areas of the bank. For example, investment banking, equities, and maybe even fixed income. You will work with a number of very creative and innovative people who are all trying to provide the best outcome and solution for our clients, but who are all working for different business groups. Therefore, this process will incorporate a range of views from very different angles. This section will drill into some of the technical and non-technical skills which are used across the investment bank. These are likely and hopefully will reflect a number of concepts and theories you will be learning in your university course. The challenge, of course, when you hit the banking world is to apply these concepts creatively and to constantly challenge these concepts to ensure that they are the appropriate ones to use.
The key technical skills you need as an investment banker are, I think, one, you need good general mathematical and financial skills.
You have to have a very good understanding of basic accounting principles.
High level of accounting knowledge.
Basic accounting. You need to understand how balance sheets put together, because at the end of the day all of our counterparties are looking to maximise the benefits of the balance sheets and different financial tools.
You know, I spent a lot of time at university thinking accounting was boring and slept through half my lectures, but when you come and sit here, it's actually something you fundamentally need to understand. It's a building block, it's not the centre of what we do, but unless you understand it, it makes some things more difficult.
I never would have thought it, but accounting has actually
armed me quite well for my job, because at the end of the day, any of these sort of complex structures that we do come down to cash flows, and one of the easiest ways to understand cash flows is having done debits and credits.
One of the things I wish I had have done was really understand the concept of cash and EBITDA and rental expenses for retail companies, so that when you're reading the press you really understand what's happening and you can say, well, they paid 10 times for that company. 10 times what?
Really understanding how money flows and moves within a business and how you can predict how those flows might move going forward, and really that can mean a good understanding and grasp of mathematics, but also a good understanding of how a balance sheet, cash flow, profit and loss statement all fit together.
You don't need a complete and utter in-depth understanding of all financial analysis, but you should be able to read it. You don't have to be able to value a company, but you need to be able to understand when we do a transaction how the bankers have valued it or how the research analysts have valued it, so that you can communicate this information to your clients and have a discussion.
Attention to detail. That's one of the things that is probably sort of drilled into the people the most, is the fact you need to have attention to detail in everything you do.
In our environment, there's just, the way that it is that there's little margin for error. So everything that you do, you need to be very confident that it's been done correctly, and there's minimal mistakes. You're always going to make mistakes. That's the way things are. But you just need to make sure that you've got the discipline to go back and cross-check your own work, and don't just assume that what you've done the first time is the right thing to do.
I also think that one of the key kind of technical skills you need is a decent amount of cynicism. There's a lot of good questions which need to be asked about why financials are predicted to move in a certain way, why does one thing affect another, and being able to identify those trends and to question them and make sure that they are what they should be is quite important. Finally, I think you just need a certain amount of kind of commercial nous, I guess is one way to put it, in terms of thinking, is there a slightly different way that we can approach this situation? Yes, it's been done 1,000 times this way before, but is there a shorter way, is there a better way, is there a cheaper way, or more efficient way that our client could get an outcome here? And really that just comes from kind of general business awareness and being able to make kind of sound judgments about what a business should and shouldn't be doing.
A problem solver. You've just got to be able to manage all the different interests. You can imagine if you're instructing advisors and you're trying to be a broker in between the corporate clients trying to raise the money and the retail investors and institutional investors putting the money in the pot. There's a healthy conflict of interest there, and you sort of sit in the middle and try and make sure that you get a security and a pricing outcome that suits both sides.
I'm a big believer that you really need to be a people person to be a great investment banker, and it's something which you can learn, and I think it's dealing with all different types of people. It's dealing with being 25 years old and talking to a CEO who's 50 and having the confidence to know that you're adding value.
This is very much a relationship-driven business, and I think not enough people appreciate that at times, that you're dealing with people all day long. It may be internal people, it may be external people. And I think learning to influence people, learning to understand where they're coming from helps you establish good points for negotiation and things like that. So we're spending more time now than we ever have in the past on getting people to develop their softer skills.
Absolutely, communication, being able to talk to investors and corporate clients, they're quite a different target audience.
Being able to communicate internally, sell ideas internally, convince other people internally that the decisions you're making are right is quite important. You need good communication there, you need to be able to structure an argument, and you need to actually believe in the argument that you're putting forward.
Being able to structure your thoughts and think methodically is a very essential skill. Secondly, I would say specific to research would be writing skills, and in that sense, having a legal training has helped significantly. Being able to write clearly and be able to convey your message or your research ideas across your clients.
Teamwork skills, the ability to solve problems, and also, most importantly, communication skills, being able to interact with clients internally and externally.
It's like in any job, it's ability to work with other people. There's no way you can do your job without working directly and well with other team members, as well as other business groups, as well as other sector teams. You have to have a very good relationship with the boss, whether that be on a very professional level in terms of knowledge, or more of a cordial team team atmosphere.
In my area per se, the sales trading role, one, you need to have a very thick skin. You have a lot of people who could be yelling at you at any moment because they're stressed and because they don't understand what's going on. You're trying to communicate a lot. Two, you've got to be able to juggle a lot of things at one time. You never have one client and one trade happening. You know, there's thousands of stocks trading and you might have clients and orders that are working across 50 and you need to be all over them at the same time, as well as the other colleagues who you're working with and what they're doing.
Just logistics management, being able to sort of juggle, 5 or 6 balls in the air at any given time. And that could be within any transaction, but often you're working on multiple transactions at the same time.
Being able to deal with high stress situations is also important. It's quite short periods of stress, but that probably makes them even more stressful.
A general understanding and interest in the business world and how companies operate, because at the end of the day we provide advice to companies. They come to us and say, think about our business and where it's going to go and help us make decisions about what we should do. And so if you're not able to understand what they do and bring some perspective to it and put it into a broader context, then you're going to struggle to provide really, really solid advice to those companies.
Probably won't believe me, but we've actually had a lot of fun putting this video together. In fact, I think it's actually taught a lot of us about what the different areas of the bank do and how we all work together. Banking truly is a dynamic industry and we have a lot of fun. And trust me, what you learn in your university course, you will apply if you end up working at somewhere like this. Anyway, hopefully we'll see you around here sometime.